Good evening, everyone. Welcome to Ask Grit, episode number 29. Today we have Phil from our Melbourne office. Hi, Phil.
Hello, everyone. Hello, Navin. How are you today?
Brilliant.
Beautiful.
Sensational in a Friday. Can't complain. All right. So what we do is on every Friday or Thursday, we bring this live program to you, discussing weekly questions which we get asked from our own investors. We want to discuss those with you so that it will add some value to you. We have been doing it the past 28 weeks, the 29th one, and the feedback has been great. So we want to continue doing that. And Phil, what have you got today?
Yeah, beautiful. Yes, so Navin, as you know, the recent news about the Australian Prudential Regulation Authorities, and they're reducing the change that they're reducing the borrowing capacity for property buyers. I just wanted to know if you can explain to us what the Australian Prudential Regulation Authority is, and what changes have they made exactly, and how is this going to affect the property market?
Yeah, so APRA is an independent statutory authority that looks across the banking sector, insurance sector, the superannuation sector. And I mean, the whole intention of APRA is to provide financial stability across Australia in these sectors. So that's what APRA does. So they are looking over the banks, superannuation, as well as the insurance industries. Now, what the changes which they have announced are, to put it in simple terms, when you go for lending from a bank, if the interest rate is about, say, 2.5%, which is a lending rate, they would take your borrowing capacity currently at about 2.5% more. So meaning they will calculate the interest at about 5% in that case. Now, what they have advised is for the banks to do, instead of 2.5% more, do 3% more, which means they'll be calculating the interest at 5.5% when you go to borrow. They have not communicated this to the banks as yet, but it will get, most probably, it will be in effect from 1st of November. Now, it's not a huge deal. What they're trying to do is to make sure people are borrowing to what they can afford to. They have found out that people have been borrowing 6 times their own income, which sometimes can be scary, especially in high growth or very expensive properties. For example, if you're buying something in Turak, and if you have few of those properties, few of those mortgages, and if you cannot service that in the long term, that's what they're trying to avoid. And they have also named few suburbs, about 20 suburbs, which they're looking at. Most of these involve the expensive suburbs such as Turak, Canterbury, and so forth. Canterbury, Camberwell were 3 of the suburbs which were in the list. So, I mean, to put that into perspective, if you were able to borrow under normal circumstances, if you were to borrow 600,000, with this change, the bank might say you can only borrow $570,000, so about $30,000 difference. So it's not going to be a big change. I mean, a lot of people are talking about property market is going to dramatically slow down, which I don't think will happen. I mean, it will definitely, the steam which is going right now might slow down, but the property market will keep going up because the fundamentals are still strong, right? Population is still will be still growing. The interest rates are at record low. I mean, these are the main drivers, and there were a lot of grants which were available for the first home buyers, and that's still the case. And I mean, as long as the fundamentals are strong, market will be going up. There might be a slight decline in the growth, which is expected. But apart from that, it's not going to be a huge deal to talk about. It's been done for the benefit of investors and home buyers themselves.
Okay, beautiful. Yeah, that was a great answer. Yeah, so another question that I get asked very common by investors is is it better to invest in an old property, one that's in an established area,
Yeah.
or is it better to invest in a newer estate, a new house? And what's the pros and cons of both as well?
Yeah, I mean, benefits of getting into an old property or established property is you'll start, I mean, if it's an investment, you'll be starting getting income straight away.
Yep.
That's one of the main benefits. And another benefit would be you see what you get, you can have a look at it, you can do a building inspection, you know what you're getting into. And if you look at the cons of getting into an old property or established property, based on the number of years which the property has been in place, you'll be at a disadvantage from your depreciation, in terms of your tax returns. So there is a lot of benefits with brand new properties where you can get a lot of tax back using the depreciation alone. So that's one of the negatives. And also, in an old property, you might have more maintenance issues coming in that might eat up your returns. So the advantage of buying a brand new property or say house and land package is you get a lot of tax benefits. It's a brand new property, so the chances of getting issues will be very less. Most of the appliances, your garage door to dishwasher to everything will have warranties 1 to 2 years, and it has a structure of warranty if something drastically happens. So you're very well secured in that sense. One of the disadvantages of getting a house and land package is you got to wait until the house has been built and then rent out. But overall, I think as investors, we always recommend going for brand new properties because your risk factor is very minimal. You'll have a lot of tax advantages, and the long term, it's going to be beneficial for you because you'll be getting more tax returns, more tax benefits, as well as in the long run, you'll be having less headaches in terms of maintaining your properties.
That is very true. That is very right. Yeah, so another question is, so let's just say I have a property, an investment property. When would be a good time to sell? And this is a very common question by a couple of my clients.
Yeah. I mean, you got to sell when the market is hot if you want to sell, but I would say never sell because when you have multiple properties, you have more power to play in the property investment game because you can create more equity on them, you can borrow more, and you can use your own properties as deposits for other properties. And so you can do a lot of things when you have properties. I mean, if you have to sell it, if it is a must that you have to sell it, you have to sell when the market is hot, like now.
Yeah, that is very true. Yeah, so this is I have a client, and so he's got a property here in Victoria, and he's an owner occupier. So he came to one of our webinars that you were presenting, which was Brisbane Boom, and so he was looking at potentially getting an investment property, and that investment property to be in Brisbane, but he doesn't have the funds for it. Is there a way for him to invest in Brisbane while having a property here in Australia? And he's had this property for more than 12 years.
Yeah, of course. I mean, if you have been having the property for 12 years, we can definitely talk to him and see what he owed to the bank, and then we can have a look at the value of the property. He definitely should have a lot of equity on the property if he has been holding on for past 12 years. Yeah. And we can take that equity out and then use that as a deposit for a property or maybe two, based on where his property is and the value and so forth. But he can definitely use the equity and put that as a deposit towards these investment properties. Okay. It's definitely worth having a chat.
Yeah, and also speaking about equity, could you elaborate more about it and explain to exactly what equity is?
Yeah, so equity is, let's take an example. Let's say we buy a property for $500,000, and then say in 5 years' time, when you do a valuation, it's about $700,000. And let's say this investor has paid off their loan up to about 400,000. Let's say the loan is 400,000, value is 700,000. The property was bought at 500,000, which means he has equity in the property. You cannot win the whole of 300,000. It's 80% of that minus your loan. So not good at maths, but that's how you do it. So 80% of that minus what the remainder of the loan is, that's your equity. And but it is based on a bank valuation, because bank will only consider their own valuations through one of the panel valuers. If they value the property at 700,000, 80% of that minus the loan value, they can take that out. Roughly should be around 180 at least in that example.
And when you say take it out, do you mean you can physically take it out and use that money?
Yeah, you can take it out and use that money as a deposit for the next property. So at the same time, your own home loan, it will go from, let's say we take out $180,000.
Yeah,
it'll go from 400,000 to 580.
Okay.
Which is okay, because that I mean, if we use that 180,000 and go buy a car, a luxury car, that's a waste of money, because it will be just for pleasure. Whereas he's going to use this money for an investment property where he's going to get a rental income, and he won't be paying that. His tenants will be paying that. So it's going to be good debt.
Yeah, beautiful. Yeah, so another question is, and it's regarding the apartment market. As we know, it's not doing as well as the housing market. So my question is, my question is to you is, what is your advice to apartment holders at the moment? And what should they do in terms of, all these negative questions about it, and so what's your thoughts and advice on it?
I mean, there is a negative connotation to apartments, but not all apartments are bad. My advice is hold on to your property if you can, because there's a lot of talk about rental income gone down dramatically, especially because of the students. But I think it's on the news today, students will be back very, very soon. So in 2022, the rental market will be a different story altogether.
Yeah.
And when the international borders are open, I mean, it's going to be a different story altogether. We are yet to see in 2022.
Yeah.
But yeah, my advice is hold on to the property if it's an apartment. Not all apartments are bad. I mean, the longer you can hold on to it is where you can play the property investment game.
Yep. Yeah, and also another question is, and this is for an investor, purely for an investor, what are areas that they should be looking at in terms of investing, and areas that you recommend? Sorry.
Yeah, I mean, if they're looking at, it depends on the state they're looking at, but if they're looking in Victoria, right now, all the suburbs are doing extremely well. The land market has gone nuts. It's very difficult to find a piece of land, even to do a package up. So if you're looking in the northern suburbs, Mickleham, Donnybrook, that area is fantastic. Western suburbs, you're looking at Wyndham Vale, Tarnet, that segment, up to regional areas such as Geelong, Barra, they're performing extremely well. And southeastern corridor, you're looking at Clyde, Officer, Berwick, and up to Warragul. You get really good cash flow, positive properties in Warragul. And I mean, all these areas are going to boom. If you look at the next 10 years, you simply cannot go wrong when you're investing in these suburbs.
Yep. That's about all the questions that I have.
Let's see what else we have got.
Yep.
Yeah, one more. With the APRA changes, which is coming up, do you think the market will come down? I think we touched upon that briefly before. The market is not going to crash or anything like that. I mean, it will probably die down the steam we have right now, but it's not going to be a big deal, as we discussed before. APRA is trying to tighten the screws to make sure it's responsible lending. You're not borrowing up to your neck, and it's for the own benefit of the home buyers and investors. It's not going to be having a huge impact at all. It's going to be the steam might go down a little bit, but the property market will still go up because I mean, we have been talking to chief economists by Westpac Bank, Commonwealth Bank, all the major banks. The predictions are that interest rates will remain low until 2023, 2024. I mean, as long as the money is cheap, people will continue to buy. So I don't think there's going to be a dramatic change in the market. All right. Short and sweet. That's how you like it. Thank you so much for listening. We'll be back again next week with another episode. Thank you.
Thank you, everyone. See ya. See you, Nevin.